Good afternoon and welcome everyone. I am Pepe Zen, Associate Director at the Atlantic Council's Adrian Arch Latin America Center. We're very excited to host this timely conversation today in partnership with the Atlantic Council's Geoeconomic Center to delve deeper into the latest trends of Chinese foreign direct investment in North America and Europe and what we can expect in the year ahead. The rise of China is one of the most important economic stories of our time, with profound and complex implications for economies around the world, including the United States and Europe. And FDI is one of those interesting angles through which to really observe how some of these developments and implications will play out. Now, in terms of FDI last year, overall, China's global deal-making activity contracted, continuing a downward trajectory seen since 2017. Most regions saw a decline in Chinese M&A activities last year compared to 2019. Globally, we're talking about 29 billion last year, down 45% from 45% from 53 billion in 2019. And when we look at North America and Europe specifically, we saw Chinese FDI declining from 31 billion in 2019 to 16 billion in 2020. In what ways did major factors like the pandemic and political and macroeconomic headwind impact deal flows last year? And how are regulatory regimes and investor appetite evolving in today's uncertain international environment? These and other related questions can be difficult to unpack because they're very much global in scope and multifaceted in nature. Luckily, we have a very stellar group of speakers to help us unpack some of these questions. Today's three speakers, Rod Hunter, Thilo Heyman, and Alexis Crow, represent just a wealth of practical knowledge, both from the public and private sectors, working with China and investors, investing community, and with a wide range of capacities. Let me just do some quick introductions. Rod, it's great to have you back. Rod Hunter is a partner at Baker McKenzie, former senior director for international economics at the U.S. National Security Council. Rod brings insight into U.S. China commercial relations, having previously managed CFIUS cases, litigated cases before the WTO, and testified before the U.S. China Economic and Security Review Commission. And Thilo is a partner at Rhodium Group and senior policy fellow at the Mercator Institute for China Studies. Thilo supports the investment management, strategic planning, and policy analysis requirements of Rhodium clients within his fields of expertise, which includes the rise of emerging economies as global investors, the implications for host economies and the global economy. And I would be remiss not to mention that Rhodium Group also recently announced a research partnership with our Geoeconomic Center to provide quarterly updates of China's policy choices and economic trajectories, with the first one being released in June, and this project is called China Pathfinder. Please stay tuned, I'm very excited about that one. And lastly, Dr. Alexis Crow, who's lead of the geopolitical investing practice at PricewaterhouseCoopers US and non-resident fellow at the Atlantic Council's Geoeconomic Center. In her capacity at PwC, Alexis helped establish the practice in 2015, which focuses on advising companies and investors on macroeconomic dynamics, geopolitical risks, and opportunities across global markets, covering some of the geographies that we will discuss today. Thank you again for joining us. And just a couple of quick housekeeping items before we go into discussion. Two special thank yous. One is a thank you to my boss, Jason Marzak, Director of the Adrian Arch Latin America Center, and to Josh Lipsky, Director of the Geoeconomic Center, for your leadership and guidance. And second, a special thank you to Baker McKenzie for your longstanding support and partnership with the Atlantic Council. Over the years, we have worked together to advance understanding of economic and business issues in the Americas and beyond. And today's event wouldn't have been possible without Rod on the panel, and of course, the broader Baker team, specifically Amy Nielsen, Roberta Braga, Nalia Honte, and Leah Schloss. Thank you so much. I should also mention that today's event marks the public launch of Baker McKenzie's latest report called Reassessing the Landscape for Chinese Investment in North America and Europe, very much timely to our conversation. This very thoroughly researched report has a lot of relevant and insightful data analysis, not just from the Baker McKenzie team, but also from Rhodium Group. We will be referring to some of these interesting data points throughout the conversation today, and I encourage you to check it out. You can find the link to download this report in the chat. Last reminder, today's event is public and on the record, currently being live streamed on our social media platforms. Thank you for joining. If you're following this event, you can submit questions here on Zoom or tweet about the event using hashtag ACChina. AC stands for Atlantic Council. We'll try to reserve 5 to 10 minutes of Q&A from the audience, either towards the end of the event or during the conversation. And with that, we'll kick off the conversation, starting in North America and then moving to Europe. Thilo, I start off with a question on you. And congratulations again on this great report that you guys put out. Let me just throw one data point at people. It's about Chinese investment into North America last year, which actually increased 40% from 5.5 billion in 2019 to 7.7 billion last year. And the 2020 level is similar to what we saw in 2018. So Teal, taking advantage of the fact that you're here as report author, based on the report, if you could highlight three main characteristics, trends, or data points about Chinese FDI flows into North America last year, what would they be?
Yeah, thank you, Pepe. There's a ton of interesting data in the report, but as you mentioned, perhaps the most surprising data point is that Chinese FDI in North America, which we define for the purpose of this report as the United States and Canada, has actually grown in 2020 compared to 2019. We've had massive disruptions in cross-border deal flow due to a global pandemic. And I think it's fair to say that both the US and Canada have had a rather complicated political relationship with China in 2020. Despite that, we've actually seen an almost 40% increase in Chinese investment in the region, which I think reminds us that political rhetoric is not necessarily a good reflection of actual deal appetite, and reminds us that investors are sometimes able and quick to adapt to new regulatory challenges or political situations. Having said that, and that would be my second point, it is really important to underscore that the overall level of Chinese FDI in North America remains very low compared to other economic ties, right? If we take the US and China, for example, both nations combined have a GDP of almost $40 trillion, right? And an annual trade of some $700 billion. Yet Chinese companies, despite those ties and those massive economies, Chinese companies have only put about $6 billion in the US on average over the past 3 years in terms of direct investment. Chinese FDI since 2017 has remained a trickle, and it is well below what we would expect from a healthy bilateral economic relationship between the two largest economies on the planet. And then a third point that I think is worth pointing out and maybe discuss a bit in the course of this next hour is that the level of Chinese greenfield FDI in North America remains fairly low. If you look back at historical FDI patterns globally, companies have usually responded to trade barriers and other political frictions by increasing their investment in greenfield operations, which allowed them to, what we economists call, jump tariffs and enjoy all the benefits of local companies. Most notable historical example, of course, would be Japanese FDI in North America in the 80s and 90s. And while we've seen some Chinese companies taking advantage of that and increasing their greenfield operations in the US and Canada, we're certainly not experiencing a greenfield FDI boom that many would have suspected based on the political relationship. And so that has many reasons, but one of them certainly is that we've gotten to a point where some of the Chinese companies that would be in a position to make those big capital-intensive investments are simply uncertain about their long-term prospects in the U.S. market, given the volatility of the political relationship in the past couple of years. And I think that's an important area to watch, especially when it comes to political support for Chinese investment, since greenfield FDI is usually what creates jobs and gets local officials excited.
Well, these are all really great 3 points that you mentioned. I think on the last one, it's interesting to look at it maybe from a global perspective, right? If the greenfield aspect of investment isn't necessarily increasing in North America, in the US and Canada, could it be that, you know, Chinese investors are looking at other destinations when it comes to manufacturing and reshoring to continue to have access to the North American consumers? But we can talk about that hopefully throughout this conversation. And then tying to your point earlier about the political relationship between the US and China, it's of course such an important relationship. Is something we'd love to discuss a little bit. And I think this is where I'd like to bring Rod in. And Rod has spent a lot of time working on some of these issues, both from the public sector and the private sector. Love to get your thoughts on the current state of U.S.-China relations and where the relationship is headed. But let me just quickly frame this in a way that Teal also mentioned. The investment volume as we see today is very much lower than what would be healthy between the two largest economies in the world. And we've seen that happening for a few years now. And more recently, earlier this year, on March 18th, we had the first official meeting between the Biden administration officials and Chinese officials in Alaska. And from what we've read, the tone of this first encounter was seen as pretty contentious. And from what we've seen, the bilateral tensions have not tapered as some analysts had anticipated. So specifically, I want to ask you, what changes has the Biden administration brought to the U.S. China relationship over the past 3 months? And in your view, what might be the possibility or degree of some sort of normalization going forward?
Thanks, Pepe. Surely, as Taylor noted, the political environment has shaped the enthusiasm of Chinese and other investors over the last couple of years. I think, for your question with regard to the Biden administration, I think what they're engaged in is an attempt to realign expectations. Since the great financial crisis, there's been a misalignment of U.S. and Sino-Chinese expectations about the relationship. Since the great financial crisis in Beijing, there's been a sense that it's past time to hide forces and buy time, and maybe time for China to take much more assertive role in international politics, economics, and so forth. And of course, in the Trump administration, we had a bipartisan reaction to some of the Chinese investments, some of the Chinese technology policy and the like, that got support in Congress as well as across the administration. But we had, at the same time, the Trump administration running several different policies all at the same time, creating a great deal of confusion. I think what the Biden administration will bring is a good deal more coherence. A lot of their senior officials have spent much of the last several decades going back to the Clinton administration in government and are very good at this. And I think we've seen that from the very beginning, much tighter coordination, much clearer signaling about what the policy orientation of the administration will be: cooperation, but competition. Competition probably getting the bigger emphasis. The way I would construe that, the dyspeptic meeting in Alaska is both sides trying to set the table for what the relationship would be for the next 4 years. I would expect that they'd be spending a good deal more time in private conversations, trying to align expectations rather than the theatrics that were carried on before the camera. But what does this mean? We had a lot of talk over the Trump administration about decoupling, and the talk, as well as some of the policy actions, I think it probably had a pretty significant impact in China, both in terms of the expectations of what the Chinese government would like to see happen, as well as also the private sector. And if you think about many Chinese businesses desiring to climb the innovation cycle or ladder, you would expect that they would see some of the U.S. actions to cut off Huawei and others is actually pretty convenient to get Chinese government support for their doing that. On the U.S. side, I would expect that the new administration will be less adamant about the decoupling, even as it focuses on supply chains. And on the private sector side, it seems unlikely that U.S. businesses are going to be very enthusiastic about trying to create the same sort of manufacturing platforms in the United States that China has so successfully created over the last couple of decades. So we have something of a misalignment of outcomes coming out of the Trump administration and the new administration, and I think also the Chinese government learned some lessons about how one can use policy to influence, use one's own regulation to influence other countries' policies. And indeed, in discussions of the dual circulation policy, Xi Jinping talked about the importance of making the rest of the world dependent on China, so that China could use the threat of sanctions as a mean to influence policy. So I clearly learned something from the Trump administration. But all that said, I would hope that we would end up with a more level economic relationship going forward, at least more predictable.
Thank you, Thilo, for that. There's a lot of good points that you mentioned. I think I'll pick up on 3 of them. One is the constructive coordination and collaboration, which I think hopefully there will be more signs of that in this administration. And speaking of that, the U.S. Special Presidential Envoy for Climate, John Kerry was just in China for a visit. At least the announcement we saw coming out of it on climate-related issues has been pretty constructive. So I see that as a good sign. And second, you work so much on the trade and supply chain related issues, so hopefully we'll be able to get into some of that as we move forward in the conversation. I'd love to hear a lot about that. And the last point is also something I'd love to get Thilo's point on maybe later on about dual circulation, a lot of different interpretation, what that means now and going forward. But we'll come back to that point a little bit. Thank you so much, Rod. So Alexis, I'd love to bring you into the conversation. Of course, if you have anything to add onto the U.S. China side of the things, feel free to do so. But I want to take advantage of the fact that you're here and ask you about Europe and Europe-China relations. And just a quick data point here again from the amazing report that Baker put out. In 2020, we saw in Europe Chinese FDI flow worth $7.2 billion, and that is a drop, significant drop, almost by half compared to 13.4 billion in 2019. And there was a lot of excitement around the comprehensive agreement on investment that reached towards the end of last year. But before we go into the agreement, which I'd love to get your thoughts on, tell us a little bit about the broader context that kind of underpinned U.S. China EU investment in recent years. And kind of with that in mind, tell us where things stand right now with the new agreement, and how do you think that might affect deal flows in both directions this year and going forward?
Thanks so much, Pepe. Can you hear me okay? Excellent. Thank you so much. It's a pleasure and honor to be with you all today. So I think it's probably important just to take a step back and to be able to consider, the global trends around FDI and this exceptional circumstances that we found ourselves with COVID-19. And, UNCTAD forecasts that FDI flows for 2020 to 2021 will drop by 40%. We've seen global FDI flows contracting by 49% in 2020. And here, I think it's just important to call out, the story of sticky capital versus fickle capital. And of course, when we think about, inflows, and particularly foreign inflows into equity markets, into sovereign bonds, fixed income, obviously these can move without investors moving around the world. And we've certainly seen that with the number of new entrants and excited entrants into the US equity market, even in Q1 of this year. But obviously with sticky capital, that's a different story. Thilo was talking about, greenfield FDI. Actually, when I'm speaking to large infrastructure investors in the Asia Pacific region, we were talking at the very beginning of how certain, let's say Japanese boards are coming to a conclusion about deploying capital to a Southeast Asian country. And now, there's use of drones to be able to look at the assets in lieu of travel. So I would just say that the conditions obviously are not necessarily conducive to large allocations of FDI on a global landscape. And I would also just say that, behind that is we've experienced a very different, uneven regional recovery across the globe, according to which obviously Asia is the standout, recovery region, China specifically the star of the region, versus, Europe, the US for most of 2020 in the teeth of the pandemic, obviously India, Latin America, continuing to struggle as well. So I think in that regard, I think it's just important to be able to take a step back and witness that, nevertheless, even though we're talking about Chinese outbound FDI, China was the single largest recipient of FDI in the world in 2020, attracting $163 billion worth of inflows. And even in the fickle markets, foreign investors doubling down on Chinese bonds. So I think important to be able to set the scene there. In that regard, I'd love to, Pepe, to your question on Europe, is just to think about Chinese outbound FDI in terms of a pure investment mindset and then a more strategic mindset. And then the geopolitical question, which you highlight. On the pure investment standpoint, what's interesting is in this uneven, even regional economic recovery, Europe facing and contending its third wave. What's interesting in the real asset space and thinking about fixed capital is because of the number of different factors contributing to sky-high valuations in equity markets, European investors continuing to pile into fixed income assets that are trading at negative yields, even just thinking about not even touching the 750 billion euro issuance yet. asset prices have remained very, very lofty. We see very little price discovery between buyers and sellers. There's a lot of room to go across fixed assets. So it's not as if there are massive discounts and dislocations to be had, which I think is one important thing to be able to call out, particularly looking to Western Europe as well. So just thinking from a pure investment standpoint, we don't necessarily see that buying moment. Then coming to the strategic side, Pepe, you highlighted in your introduction, if we think about Chinese outbound FDI on a global basis, we have obviously seen the government stepping in to be able to reduce from 2017 onward. 2015 taking a knock with the depreciation of the RMB, and then 2017 onward. And I think, where does Europe stand within that context is an excellent question to be able to address. I think if you look to a country like Germany, I think it tells a very interesting story. Recently ranked 10th down on the list of most desirable countries on a country basis to magnetize Chinese FDI. And I think, here's where the business cycle comes in, where some of this investment is I think opportunistic coming in after the GFC, and then thinking about the ways in which this FDI is underpinned by strengthening export ties, I think cannot be discounted. The importance of that is very real. Certainly, I think when I've met with some of the entities that are targeting or looking at German companies to be able to invest in or acquire, it's very much driven by that other macro piece of the Chinese successive plenums, which is innovation-led growth. And so thinking about family businesses that are potentially looking to a succession, and all playing into Beijing's innovation-led growth. I think this trade tie continues to be underpinned by, again, strengthening exports. When we think about some of the German companies who have lost export markets with regard to the U.S. tensions, who have then not necessarily been able to perform well in U.S. sales throughout 2020, a lot of those lost sales, not only in the US, but Europe, have been made up by China. So I think for this reason, there's a little bit of, I wouldn't call it schizophrenic, but potentially sort of bifurcated approach, according to which you have ministries of national security and foreign policy, thinking and saying one thing, heads of state with an Indo-Pacific strategy, whether that's Macron, whether that's Merkel, thinking another thing. But then, the very viability of some of these largest companies, headquartered in Germany, being underpinned by these export ties. And so I think that's important to call out with a country like Germany. On a country-specific level, I think it's going to be very interesting to watch Italy as well. Coming to the geopolitical lens, which you mentioned, and the historic agreement being penned at night, the last hours of 2020. To then be called into, I think, question and doubt. Putting the politics of the agreement aside, what I would say is, just to highlight is, I think we still have an elusive federal agreement, full stop, on free trade between Beijing and Brussels. And I think we will continue to see differing national policies with regard to Beijing, even in the midst of this agreement being on the brink. We have seen various, and Rod can speak to this on the U.S. side, we've seen various national decisions to be able to issue reports to restrict inbound FDI in specific sectors, whether or not that's UK, whether or not that's Germany. And I think we will continue to see that grow, but balanced again, those strengthening export ties. And it goes without saying that, where we've seen exports diverted from Italy and from Germany away from the US, again, it's strengthening toward China. And so in that realm, I think just looking forward, what I would say is that in lieu of that agreement, it's probably going to be more on a national basis as opposed to a federal basis.
Thank you so much, Lex. That's extremely helpful. And I particularly like the three of the points you mentioned. One is kind of you bringing that global perspective, looking at an uneven global recovery and see what that means in terms of valuation and the attractive assets from an investor perspective. And second is precisely that investor mindset, the kind of differentiation you made about the pure investment mindset versus the more strategic one. That's very, very interesting. Thanks for bringing that up. And the last point, when you talk about the agreement between EU and China and the sub-regional national dynamics, I thought that was very, very interesting. And Thilo, I'd love to bring you in some of these issues, whether you want to comment on the global macro piece of the things, or you want to go into the sub-regional dynamics and differentiations within Europe. Please feel free to go ahead.
Thanks, Pepe. Maybe just 2 quick points in response to what Alexis just mentioned. 2 additional perspectives on a macro piece. I think the first one is, I think Alexis called it opportunistic buying opportunities. I think historically, you look back to 2010, 2011, the one difference today is that you have a lot more liquidity in the market and a lot less pressure, especially on small and medium-sized enterprises, to bring a strategic investor on board to avoid bankruptcy, right? That's how Chinese investors have been acquiring quite a few assets in the industrial sector, for example, in 2009 through 2012. And I think that is fundamentally different nowadays, that from a supply side, there's less of a desire to sell a stake in a company to an investor who's from a complicated country like China. And then the second point that is important when you look at valuations is that it's not just a hurdle from a financial feasibility point of view, but Beijing also has an explicit policy in place now to curb irrational investment. And again, looking back the last 10, 15 years, Chinese companies have not been great at timing the market. They bought at the peak and then sold at the bottom. So Beijing very much has this greater focus on risk control and making sure that Chinese companies, private companies, and especially highly leveraged private companies, are not buying into what they consider inflated assets. And so that is certainly not a great situation at the moment if you are a Chinese buyer and you want to get approval from Beijing to make an overseas investment. So just to round that up, but otherwise, yeah, great points. On Europe in particular, you asked about the bilateral investment agreement. I think there are very big question marks right now around the ratification, given where the EU-China relationship has been going the past couple of weeks. And the agreement itself, I think, was most important for European investors looking into the Chinese market. From a China outbound perspective, it didn't really change the landscape for Chinese investors. The additional market opening would have been very marginal, and the agreement did not prohibit the European Union to implement any of their defensive instruments. The single most important purpose, I think, that the bilateral investment agreement would have had is to sustain broader support for open investment environment to China and the world. So if it would be implemented, I think it could partially address some of the concerns that exist in Europe about asymmetries in market access, which in turn, I believe, would increase the likelihood that Europe's market will remain open to Chinese investors in the long run, outside of some of the sensitive sectors that we're talking about. But again, I think at this point, it is far from certain that the European Parliament will ratify this agreement in the third or fourth quarter of the year.
I absolutely agree, Thilo. I think, sorry.
No, so Pepe, if I could just pick up on both Thilo's but also Alex's excellent points. So, yes, China did have a great pandemic in many regards economically, and the United States, while getting a slow start, has actually done very well. And that, in terms of the impact on deals, the first quarter, obviously before the pandemic hit, was a lot like 2019. The second quarter, everything ground to a halt in terms of specific transactions, and then in the third and fourth quarter, the velocity of transactions picked up. And so I think that probably, and Taylor could speak to this, but that probably speaks to the numbers. But for what happened in the second quarter, you might have had even significantly larger FDI numbers from China in 2020. But one of the things that may be driving that may be greater stability at the regulatory perspective. It's useful to remember 2019 was at the time of 2018-2019 timeframe was the period of the greatest regulatory uncertainty for foreign direct investment, at least in the United States, but I think also for a number of European jurisdictions. And since then, we've had the new regulations implemented. There's greater clarity about where the regulatory authority will intervene, make it a lot easier for advisors to advise and investors to invest.
Thank you, Rod. And this is a great point, because I was just about to bring you in for the regulatory side of the things. I think Alexis and Thilo together gave us a very interesting perspective from an investor's perspective and from the investee's perspective. We look at valuation, we look at attractiveness of this asset, we look at how liquidity conditions have changed. But of course, one thing is what the capital is available and where the investors will be deploying their capital. The other thing is, how much of that would actually be considered friendly in an environment, and how they would actually pass the investment screening and the regulatory screening that we face. And I wanted to bring you in for this question because you've worked really a lot on this, both from the public sector and the private sector, and both from Brussels and in Washington. So, and just a reminder for folks who didn't get to watch a similar event we organized with Rod and Thilo 2 years ago, we also had a panel to discuss how we compare the regulatory environment in Washington and Brussels. At that point, the consensus seemed to be that, it's also tightening in Europe, but it seems more welcoming to the Chinese investors and Chinese investment than the U.S. counterpart, which, to your point, 2018, 2019 was a difficult, if not unpredictable time from an FDI, inbound FDI screening perspective. So my question is for you is twofold, Rod. One on the public sector side, one on the private sector side, taking advantage of the fact that you worked on both. On the public sector side, do you think what we discussed 2 years ago, does that conclusion still hold? Do you think that kind of regulatory comparison still hold? On the private sector side, and also kind of tying into what Alexis is saying and what you mentioned, kind of the different paces of recovery across the world, are the clients you're working with, how concerned are they about this very uneven recovery and not just the macroeconomic but geopolitical risk? And what are you doing to advise them to navigate this environment?
Well, so Pepe, on the first part of the question, yes, there is a regulatory difference between the United States and Europe and also a couple of other jurisdictions, but the direction of movement is largely the same. Just as we were talking 2 years ago, there was increasing attention to the national security implications of foreign direct investment, and of course, the pandemic gave people another reason to focus on the security of supply with their own countries, whether they had enough personal protective equipment or now vaccines. And so we've had one debate taking place about national security around foreign direct investment. At the same time, there's now an emerging debate around industrial policy under the name of supply chains. And the two ultimately, I think, will intersect in ways which will make it a little bit more challenging on the foreign direct investment side. But focusing on the first component, we've seen regulatory action in Germany. Germany's modified its regulatory regime a couple of times in the last 2 years. The UK is implementing its own, France, Italy, Spain, so that you now have prior approval regimes where they did not exist before. None of those regimes, however, are quite as comprehensive, shall we say, invasive as the U.S. regime administered by the Committee on Foreign Investment, CFIUS, or the analog in Australia, FIR, which also is quite thorough. And one of the things that's kind of interesting about this evolution is that the real focus has been less on technology, although that's obviously a driver. It was certainly the motivation for a lot of the investment that attracted attention back in 2018 with the legislation. And increasingly, the focus of regulation is on access to sensitive personal data. And so when we see the regulators intervene, it's particularly focused around the risk that hostile intelligence services may use data that's scraped from targets for malevolent purposes. And that's particularly so in the case of the United States and Australia, maybe a little less in Europe. But I think on the private sector side, I think there is an expectation that deals are a little easier to do because just the regulatory regime is a little less complicated in some of these regions, but you do have more countries with their approval regimes. And so when we're doing multi-jurisdictional deals, as almost every deal is these days, just as you have to run the analysis around competition law, you have to run the same sort of analysis across jurisdictions for foreign investment regulation as well. And it sometimes has an impact on the structure of deals, what pieces have to be spun off, just like with competition regulation.
Thank you, Rod. That's very helpful. I particularly like the point about kind of the evolving focus of some of these screening regimes in different jurisdictions, and specifically when you mentioned about access to sensitive data, which we'll keep an eye on that. I'd like to, Alexis, I'd like to bring you in to mention something. Ask your thought on some of the more global issues. You follow again different geographies. So as we talk about Chinese FDI, in Europe and the U.S., what about other geographies? I'd love to get your thought on that before kind of taking Thilo up on his previous mention of dual circulation, having talked more about the China outbound side of the story. But Alexis, please go ahead with what we see in other geographies from investors' perspective.
Sure, thank you so much, Pepe. So I think, important to point out that over the last 2 decades, we've seen Chinese outward FDI grow, from basically nascent, $1 billion to 117 on an annual basis. And so just thinking about some of the other geographies, I think it's important to be able to distinguish between the evolution of actors, geographies, and sectors, and just thinking over those last 2 decades. And here, actors, we've touched a little bit upon this, but here I would say that in the initial days of what the government called going global, what I would identify was you had an extraordinary resource play in acquiring raw materials and resources to be able to fuel China's extraordinary manufacturing miracle. And this is where companies, in the energy space that what I would call private or semi-sovereign within China were some of the largest employers in the world. 1.6 million people on the ground, anywhere north of 500,000 people. And very, highly acquisitive across the globe. Obviously, we've got some, large Latin American contingent here, Brazil being a favored destination. Thilo also hinted the lack of dislocation purchases, and what I would say is a lot of that energy acquisition happened at the height of the commodity super cycle as well, so valuations being fairly lofty. And as we see China, like other advanced economies, moving from manufacturing and industrial-led toward more of a services providing economy and consumption-driven economy, so I would say some of that exporting of excess capacity, also coming from the domestic infrastructure boom, segues nicely into Belt and Road. So then I think you would think about some of those other actors, moving along the bonds that were built along Belt and Road into some of the more infrastructure plays. Important to also note there that obviously the government has a very clear handle on the ability to use the export of excess capital as a tool in the basket to manage appreciation of the RMB. So another important thing to point out. Then thinking about some of the other actors, I would say you have the private side of things, obviously private Chinese companies, specifically state-owned enterprises, and then what I would call would be some of the more sovereign investment funds who are continuing to step up their direct investments in major infrastructure assets across the world. So in that sort of setting of the various actors, what I would say is, we haven't talked about ASEAN, and here, this is the world's basin of the fastest growing countries, by economic growth, highly productive countries. And here's what's an interesting thing is, the latest data we have from UNCTAD actually shows that U.S. FDI into ASEAN is basically treble what it was in China for 2019. And so coming into countries like Vietnam, Malaysia, Indonesia, and what I would say is Japan continues to remain the dominant player here. Latest data we show that Japanese foreign investment into ASEAN is basically double that of what Chinese FDI is currently, but it's ever increasing for China. And here's what I would say, what is being driven by that on a sectoral basis is this is China's China plus one strategy that it's implementing itself, according to which we've had a wage diaspora of higher wage jobs moving off of mainland China down through the shores of Southeast Asia into industries such as textile and manufacturing, light electronics. And there I would say, the running joke when I was last in Hanoi was, are the Chinese just exporting inputs into Vietnam and then, everyone stamps a box and says that it's made in Vietnam and then sends it to the US. And I think, that goes without saying that we continue to see that. So, coming back to some of the trade agreement discussions we've had, will RCEP enhance this? I'm kind of with Thilo on, plus ça change with the comprehensive investment agreement, plus ça change with RCEP. I think, the growth story is there and it's ever present, and that will be driving Chinese outward FDI to that region on a business basis, in a business mindset. Coming to Latin America as well, obviously a large contingent we have on the call today, thinking on a country basis, I think what's interesting is really from Dilma's impeachment onwards, which does kind of show that geopolitics might also have an input into FDI. We've seen, I think, other countries growing in favor as recipients of Peru and Chile. Sectors evolving, not necessarily purely raw materials, but also thinking about sectors such as telecoms, I think is also an interesting one. It was Chinese demand that supported Brazil's single largest export expansion and manufacturing expansion and GDP expansion in Q3 of last year. So I think that's also important to be able to point out. And we're seeing leaders by and large be pretty positive toward this, and we'll see how that plays out with the Biden team. I'll hand that tough question to Rod. And then I would also just say that thinking about, rest of Asia, I think, and thinking about other sectors, part of the dual circulation we mentioned, but also just thinking about innovation-led growth, we have also tracked a diversion of capital in strategic high-tech sectors away from Silicon Valley and toward Bangalore. So thinking about more of the VC type capital. And I think there are question marks as to the relationship between New Delhi and Beijing throughout 2020. But, we continue to monitor that trend of FDI there. And then lastly, something I did want to call out from the Baker McKinsey report was also Canada. And we were talking about North America and Canada and thinking about some of the Chinese capital that's coming into the Canadian market. Here, I would just say that on a sectoral basis as well, it seems that real estate is like a little litmus test. It's like putting your little toe into the water to see how it goes. And certainly what we've seen, and I've been a beneficiary of that in New York, is a diversion of real estate capital away from the US, just given the geopolitical tensions. And I think Canada's been a huge magnet of that. So with that, I know it's a lot, I will stop.
Thank you, Alexis. That was very helpful. I mean, overall, the global perspective, that's something that we really appreciate you providing. And the point about kind of the economic conditions driving BRI, in Washington, sometimes we're very much focused on geopolitical side of things. So absolutely on the same page about the economic rebalancing, the potential excess capital and going off broad. And I think that's a great point. Thank you for mentioning Latin America. As you know, I work within the Latin America Center. So it was great that you talked about this region. And as the Baker McKinsey report actually mentioned, that Latin America is one of the few regions that in last year saw a very consistent, even consistent level of Chinese deal making when we look at M&A. So something to follow there. I'm not going to dwell too much on the public-private comparison point, but I know that Thilo also had done a lot of study just comparing the private sector investors in China, not necessarily the sovereign funds, but also the SOEs investing in other markets. So if he wants to comment on that, please feel free to do so. But Thilo, as mentioned, and Alexis has always laid a great foundation for what we can talk about, starting off with China going global. So starting from that and see where we are right now, looking at China, Chinese outbound investment, what's the Chinese perspective on this? How are Chinese leaders and investors adapting to this rapidly evolving environment is sometimes an unfriendly one in their perspective. And specifically, since you mentioned at the beginning dual circulation, I'll take you up on that. What's your latest assessment of that, and what's the global implication of that?
Yeah, that is a very profound and deep question. I think that there's two dimensions that are important for answering that question. The first one, there is a deep struggle going on within China over the direction of the economy and economic policy, state versus market. When President Xi took over at the outset, he did promise to double down on reforms and let the market play a decisive role. I think they tried a couple of times. It always failed. It always came at the expense of political control over the economy. And I think it's fair to say that the trend over the past couple of years domestically has been going more towards state and not the market. And then, of course, on top of that is what Rod earlier mentioned, is that China, Beijing has been reassessing the opportunity versus risk from globalization equation, right? They have been a massive beneficiary from globalization over the past decades, but they've also seen some of the big risks from U.S. sanctions, U.S. cutting off semiconductor supply chains, things like that. So there is that dimension, that discussion right now playing into that fundamental domestic discussion. And when you look at the outbound policy regime, it's a pretty good illustration of that foundational discussion. And in my view, really the most important variable to watch going forward. Yes, CFIUS is important, what the UK will do, what the EU will do, but really the fundamental question is, what is Beijing going to do on the outbound investment regime side? In 2014, they had gotten to a point where they said, hey, we want to give private investors more responsibility to let some of these outflows happen. We don't want the central bank to accumulate reserves. We want this money to go into productive, high yield assets that enhance our economic development. And so they liberalized the outbound FDI environment, which then led to this massive run-up in outbound investment. And everybody in Beijing at that time, starting in 2014 all the way up to 2016, 17, was doing something with outbound investment. And so very quickly, it got to a point where it was uncomfortable. The level of outflows became uncomfortable for Beijing in terms of pressure on the currency and possible capital flight. And so they decided to step back in and say, well, end of 2016, early 2017, it's gotten a little too far. We got to crank up down here on risk and kind of retighten some of these controls. And looking back at 2020 is a pretty good example of where we are right now, that China had record inflows through the trade, to the current account, the trade balance. Chinese tourists couldn't go overseas anymore, spend money, so they had to find ways to let money leave the country. But they didn't revert back to private investors, but most of that was happening over the past couple of quarters through state-owned banks or very tightly controlled outbound investment schemes that allowed some level of control, and not again through this run-up of private outbound FDI. And so I think that is the big question going forward. How is that going to play out? My view is that ultimately there is going to be the realization that without outbound investment by private companies, China is not going to remain competitive. All the upgrading that needs to happen, all the post-sales service investment that keeps Chinese companies globally competitive needs to happen. So I think ultimately there'll be a reversion to a more supportive liberal outbound FDI policy. But again, that remains very tightly knit with the broader macroeconomic outlook and certainly the political situation in China as well.
Thank you, Thilo. I'm going to bring Rod in just really quickly on some points related to that and another regulatory question, and then come back to you for even further explanation on dual circulation specifically, if that's okay. Rod, so something that I remember from one of our conversations last year, to one of Thilo's point was, we can't just look at what's happening in Brussels and Washington. We also have to look at what Beijing is doing. I think we might have discussed that in the context of political relationship and U.S. China relations. What's happening on both sides of the Pacific Ocean is important. So based on Thilo's point, how do you see that evolving going forward? Based on what Thilo said about, public versus private, that sort of dynamic, do you see that impacting deal flow in a significant way? So that's the first question. And second, we had a question from one of our audience, and this question was related specific to CFIUS. As you have so much knowledge on it, I'm going to pose it to you. And it's about deals that have already been approved, and when they've gone through the security screening. Is there a way to retroactively screen those through CFIUS and other mechanism? That's question that I'd love for you to answer, if that's okay.
Okay. So the second question first, because that's the easiest. If once a deal has been approved by CFIUS, it's approved. CFIUS can't revisit it unless there was, false statements made during the filing, or unless there is some form of new investment. Now, CFIUS clearance only protects against a future CFIUS review. There are other forms of regulation, and indeed, the recent interim regulations, which came into force in March, which allow the Commerce Secretary to block the sale of Chinese-made information technology and communications equipment, could effectively have the same effect of throttling an investment if it got caught up with it. But CFIUS clearance is CFIUS clearance, and that's the whole reason why the system worked from the beginning as a voluntary system. On the broader question, I thought that Taylor raised a really interesting point about earlier in the conversation about how low, Alexis mentioned it too, how low Chinese foreign direct investment is relative to the size of its economy. Most major economies, the stock of FDI abroad is about a third of the country's GDP. And Taylor will know the number off the top of his head, but my memory of it for China is something in the range of 10 or 12% for China. So massive economy, one of the largest economies in the world, but underinvested in the rest of the world, even with the Belt and Roads Initiative that's obviously focused much on Asia and Africa. The second thing I would mention is one of the big impacts of the Trump presidency was to shift something that sociologists call the Overton window. Overton window is sort of what is acceptable to talk about in politics. And generally, politics takes place within the bounds of the Overton window. President Trump shifted that in many ways, a lot of ways, but certainly on globalization. And so I think, Taylor's point about the Chinese leadership rethinking globalization, I think you're finding that the countries, governments around the world, and in fact, businesses are rethinking the shape of globalization going forward. And that's what I was alluding to earlier when I mentioned the discussion in Washington these days around supply chains. We had in the Trump administration increasing regulation of supply chains and foreign direct investment, sanctions, export controls. And now we have the new administration undertaking a review of the supply chain, about 5 or 6 different strands, which basically are, it's an exercise to assess where there may be vulnerabilities, but also to find ways to increase jobs for Americans. And it's hard to see how this doesn't play out in tension with the open market, which the U.S. has promoted over recent decades. And I think you'll see a similar trend in Europe. And so there is, in a sort of a secular political trend of tension or stress on the international system which we've created over the past generation or so.
Thank you, Rod. And this is a perfect segue for me to kind of help wrap up this conversation, bring in Thilo and Alexis. You mentioned the word secular, and this is actually how I think about a lot of these issues. Think about what are some of the broad sets of factors, impacting Chinese deal flows on a global stage. I think about, on one hand, the secular structural issues, and inspired by Alexis, I think one of the structural major issues might also be just the growing attractiveness of some of the ASEAN economies that could also be part of the equation. And then on the other side, I think about some of the more cyclical issues, some of the temporary factors. The pandemic obviously being one of the most emblematic one in that regard. So I wanted to just naturally bring in Thilo and Alexis in this conversation to help wrap up. What do you see as perhaps the top structural versus temporary cyclical issues on that regard? And I think Thilo, if dual circulation comes up in one of those points you made, that would be fantastic. But anyways, I'll leave that to you, if possible, 2 minutes each. We'll start out with Thilo, I guess. Or Alexis, go ahead, please.
I actually did want to segue from what Rob said. I actually just wrote a publication on this, and it was, I think politicians are saying one thing, and it's very romantic and alluring to talk about reshoring and localization and onshoring. It's highly ineffective in terms of cost. And so that's where I think the business mindset will start to re-enter once countries have emerged from the teeth of the pandemic. Nevertheless, I do think there will be, China will continue to be a highly politicized part of the dialogue in a lot of the countries that we've mentioned today, such as for the 2022 election in France, such as in Germany as well, such as we're continuing to witness in the UK. So I would just say that I think all of the different types of actors that we mentioned today with regard to China, I think you will see, a tighter rein that Thilo mentioned, more of an impact on performance, but I think you will see a business mindset continuing to drive some of that outward FDI.
And then that's a great point, because when we look at, especially coming back to Latin America, my region, when we look at how some of the countries can take advantage of the reshoring, nearshoring opportunities, it's really not easy. We're talking about some of the longer term, regulatory reforms to ensure that the business climate is attractive for investors. Without that in place, the opportunities, even the low hanging fruits we talk about, these are difficult to materialize. Thilo, I'll turn it over to you.
Well, we talked a lot about a number of the cyclical factors that are at play, right? Money supply, valuations, what kind of choices you have as a seller of an asset, geopolitics, political tensions. But really, what I think it boils down to at the end of the day is the question of which direction is China's economy going to take over the next 10 years, and what does that mean for the relative value and importance of outbound FDI, globally operating subsidiaries for Chinese companies. And one of the reasons we are so low in terms of China's outbound FDI ratio is that opportunity at home was just so massive that companies didn't have to go abroad to grow 20, 30, 40, 50% year on year, right? And that is, I think, coming to an end, but that is a big question. And then certainly from a host country perspective, especially looking at advanced economies, Europe, North America, what does China's economic direction mean for the compatibility or interoperability of our economies, right? Is China going to let the market take a decisive role, or is it going to go more in the direction of a state-controlled, a party-controlled economy? And if that's the case, then there are just some limits to what extent we can allow these two-way deal flows in sensitive sectors. And the definition of what a security relevant sector is going to further mushroom and balloon. So I think really that's, if I could say one thing, it's really what is the future of the Chinese economy going to look like structurally in terms of state versus market, and how is that, is there a broader convergence of the economic model with the OECD or not, and what does that mean for our openness to Chinese investment?
Thank you, Thilo, for that. And that's an evolving story that will continue to follow. And one of the tools to follow that is, the China Pathfinder projects that you guys are partnering up with our Geoeconomic Center with quarterly updates. So folks, please stay tuned to that. With that, we'll conclude today's event. Thank you, Thilo, Alexis, Rod, for your comments. Really complementary, interesting, contrasting perspectives on a lot of these global, Chinese, U.S., European issues. Thank you so much for your time. And I'll say also a great thank you to my team. Angela Chavez and the AV team here for supporting this event. Without your support, this wouldn't have been possible. And of course, my colleague Ole from the Geoeconomic Center. Thank you so much. And hopefully we'll be able to reconvene 1 year from now to look at the new numbers and have a similar discussion about this.